From New York City for our viewers worldwide, I'm Matt Miller. Futures rocket higher after another better-than-expected inflation print. The countdown to the open starts right now. Coming up, the latest Fed inflation print, the latest inflation print, nothing to do really with the Fed in terms of the data, that's BLS. Coming in lower than expected, sending futures rising and yields falling. And as the Fed signals just one rate cut this year. We begin with the big issue, mounting evidence of disinflation.
We're expecting a downside surprise on PPI, and we were actually one of the few shops expecting a 0.2 on core CPI yesterday. We have been watching the data slow and think there's a slowdown underway, but we got an FOMC that really just seems to think growth's fine, and not just fine, but great. It really looked to us like an FOMC that seems very comfortable waiting and without a lot of urgency to start dialing back restrictiveness.
Joining us now to discuss is Liz Young-Thomas, SoFi Head of Investment Strategy. Liz, great to have you on the program this morning and on a good news is good news day, right? I mean, inflation slowing down for the PPI after the better than expected print yesterday for the CPI. Markets rocket higher again. How much more room does the S&P have to run?
Well, I won't put a target on the S&P, but I do still think that the market is in a mode of celebrating cooler data, celebrating economic data that comes in a little bit slower, but not too cold. And I think we'll stay in this phase for a little while still because we've been waiting for it. We've been waiting for inflation data to give us some decisive moves downward and frankly, been waiting for at least something to have a negative sign in front of it, because what we've been talking about for so long is that, yes, inflation stopped growing as quickly, but it was still rising. So what we needed to see in order to actually take some of the pressure off of consumers was for there to be some month-over-month negative prints. Now, many times that gets misinterpreted as a contraction or something that's terribly wrong, but really when we're looking at the cumulative effect of inflation since it started rising, consumers are dealing with over 20% up in prices in many of those non-negotiable items. So this is still being celebrated by the market, as I think it should be. As the year drags on, the question becomes, when does cooler data become too cool, and what will the Fed do as a response?
Well, in which industry groups is it not great news for? I mean, yesterday we were talking to David Rosenberg. Of course, he's a noted bear, but he says, look in the beige books over the past year, and you'll see that pricing power is declining, right? Corporations are having tougher times raising prices. Where do you see the pain from this?
Well, raising prices, that is true. It is true that it's tougher to pass through the pricing increases that have occurred because everybody knows that the story is inflation has come down, or at least the growth of inflation has come down. So those pricing pass-throughs that benefited companies through much of 2023 because it grew the top line. So it grew revenue because prices were being increased by passing them through to consumers. That has slowed down quite a bit. So now it's a matter of, can companies manage their operating margin with revenues that are no longer benefiting from those pass-throughs? And that's going to go to companies that are well capitalized. It's going to go to companies that have a strong competitive position. And it does make things more competitive in certain industries. As inflation falls in the goods sectors first, it's been more difficult for those companies to pass it through. So companies that are very goods intensive. We've still seen quite a bit of sticky services inflation. Now, I don't think that companies are going to be able to pass that through as easily, but there is still pricing pressure on the upside in some of those services components.
All right, hang on a second, Liz, because I do want to talk more with you about the consumer. I think you have a great perspective on the consumer from SoFi, but right now I want to get in a little deeper to the economic data. More signs of slowing inflation here in the U.S. The producer prices, PPI, decline in May, an actual drop, and we were looking for a rise. Let's get over to Michael McKee, Bloomberg Chief Economics and Policy Correspondent. So, Michael, good news is good news.
Well, good news is good news if you're looking for a rate cut. Jay Powell told us a story yesterday. We needed to see weakening labor market and falling prices before we get a rate cut. Well, guess what we got today? You can see what happened with the PPI headline down 0.2 on the month, and the PPI core came in flat. Jobless claims jumped by 13,000. Question is, will that continue? We're going to have to wait a couple weeks and see if this is a new trend in terms of layoffs. But in terms of prices, what happened? Well, we got a way to show you that. If you have a Bloomberg, go to ECAN Go, and it breaks down what happened. And if you don't have a Bloomberg, call us up and we'll get you one. But you can see there, purple is energy in this chart. And you can see the big move was in energy. Liz mentioned that, down 0.8%. It really pushed PPI down overall. That raises a question of whether it will continue. But what we're seeing in retail gasoline prices when you go up the ladder here is that we are still seeing some declines in prices, which would affect consumers and be good news. Now, overall, the Fed is going to be looking at what's happening with inflation more than jobs at this point, because it's only the jobless claims numbers that changed. And when you look at what's happening with inflation, they want 2 or 3 months. Well, they got at least a month here. We now see that the PPI and CPI went down on a headline basis over the last month. PCE is the one we have to wait for at the end of the month. But now with PPI in, we're going to start seeing some people figure things out. And my initial guess is we're going to see PCE come in rather low as well, if not negative by itself. So the story the Fed wants to see has at least started.
Mike, I had a viewer write in yesterday and say, you know, we're adding jobs to this economy. The World Bank is raising its expectations for growth. Markets are at an all-time high, like 27 new all-time highs this year. Why on earth would the Fed cut rates? Who thinks that these rates are restrictive?
You know, it's funny you should mention that, because I asked Jay Powell that exact same thing yesterday. And basically what he points to is the impact of real rates on the economy. As inflation goes down, real rates go up. And so the Fed doesn't get any looser, and that's hurting things like housing. It makes bank lending much weaker. And so at some point, they think this is not going to be, the 5.5% top is not going to be the level that's appropriate for the economy. They just want to wait and not move it down until they are certain they aren't going to have to move it up again.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Chief Economics and Policy Correspondent, talking to us about the data. Liz Young-Thomas from SoFi, where she is Head of Investment Strategy, is still with us. And Liz, I think at SoFi you have a really unique perspective on the consumer. And that's probably one area where people are wishing for rate cuts, right? It's more expensive to finance a home than it has been in a generation. It's more expensive to finance a car purchase than it has been in a generation. How is the consumer doing now, especially since we see savings rates just have completely dropped to pretty much zero after the pandemic?
Well, I think one of the most important things that Mike talked about was that energy prices have come down. And we know that just the feeling of energy prices coming down and prices being lower at the gas pump does help consumers' sentiment rise. So when you look at surveys like the University of Michigan sentiment survey, that is tilted more towards inflation as a data set. So I would expect there to be some increases in the University of Michigan sentiment survey. So I think overall consumers are hearing this news and feeling good about the future. And that's been something that has been a weight on some of those numbers in the past. And I'm talking about the sentiment numbers. Consumers get asked, how do you feel about the present situation? How do you feel about the future situation? And the future had been sort of a drag because people were worried that inflation would not come down or that it would stay this high and they would continue to have this pressure. So I think these are good signs. What we've seen in a lot of the consumer spending data, and this is consumer spending data at large, yes, they've slowed down in some places. Yes, credit card debt is higher, but consumers still want to spend. They're still optimistic that they can continue to do so because the labor market has remained strong. I can really only say that for this moment in time. I do suspect that as the year goes on, the labor market will cool further. And I think it's going to be difficult for the market to get used to something like an unemployment rate above 4%. We only just had our first 4% unemployment reading, and that was after 28 straight months of unemployment below 4%. So I think there's going to be a little bit of a digestion process there. I would expect consumers to pull back a little bit further, but not yet freak out about the data being a bit cooler.
How does the labor market look, especially for your clients? I mean, Gen Z, they're still very young, but they haven't been getting promotions. I think in the last year, it was only 2.1% of respondents to a survey said they'd gotten promotions, and it had been higher, like 2.5%. This year, we've seen the least promotions for the entire workforce in at least 5 years. So even though, people got jobs, they're not quitting and they're not getting raises, or at least the salaried workers aren't getting promotions.
Well, the quitting part of the equation is really just getting back into balance with where we were pre-pandemic. And we know that we had this very, very tight labor market after the pandemic where there weren't nearly enough workers to fill the jobs that were open. And now a lot of those balances are coming back into a more comfortable place, which Jerome Powell has referenced a few times in his press conferences. So we want to see the labor market get back into a better balance that way. If it weren't, and if employees still had quite a bit of that power, we'd see wage pressures rising. And that's when we used to talk so much about the wage price spiral. So those risks have also come down. I would view that as a positive. The voluntary quits rate is a good indication of how people are feeling about whether or not they would get a different job that was better or higher paying. And it seems lately like people are staying in their spots for longer. Again, this is not a concerning thing, perhaps frustrating for people that had expected the labor market to stay in the ways that it was before. But this is not necessarily something that's sending a signal that the economy is in trouble. Unemployment sends a signal that the economy is in trouble. Jobless claims send that signal. That's not what we're seeing right now.
What about debt loads, Liz? I mean, people come to SoFi to consolidate debt. Student debt is a problem that people have been talking about for a long time. Now we see, there was a great story in the Bloomberg yesterday, some companies are helping employees to reduce their student debt along with matching 401k contributions. But you've also got buy now, pay later, which is hard to measure. I mean, how does consumer debt look to you?
Well, if you look at all of the data that's out there about credit card debt, auto loans, and delinquency rates, we have seen an increase in delinquency rates, and it's been pretty steady over the last few quarters, both in auto loans and in personal loans and in credit cards, and that's for the U.S. at large. That's not specific to SoFi, but there has been an uptick. Now, it's easy to look at that data and see the uptick and be concerned with it. And I do think that it's something we need to watch. I do think it's an indication that consumers, particularly on the lower income side of things, are feeling a pinch. But if you look at it over a long period of time and compare it to previous crises, especially financial crises, it's not at a concerning level at this point. But it is something that we do need to watch, and it is something that is increasing the delinquencies in consumer lending.
All right, Liz, thanks very much. Liz Young-Thomas there, SoFi head of investment strategy, talking to us about the economy, the Fed, and the consumer. Joining us now with a look at the stocks, individual stocks moving ahead of the opening bell, is Abigail Doolittle. Abby?
Matt, we're getting pretty used to the S&P 500 and the NASDAQ making new all-time highs, but what we're not used to is Tesla being a part of it. But today that is the case, at least in the pre-market. The stock up nearly 7% as CEO Elon Musk on X said that shareholders had approved his, in theory, $56 billion pay package. Now, this doesn't really carry a lot of legal ramification, but it's more symbolic of trust and faith in the CEO and the fact that he will be staying at Tesla. So again, those shares up sharply. Broadcom, this stock is soaring up more than 13%. They beat. There's a positive forecast. But very importantly, the growth coming from AI really offsetting weakness for some other chips. Investors liking that a lot. And then finally, roaring kitty back in the news. GameStop, after plunging 17% yesterday, up 3% 3% in the pre-market today. The calls that he is supposedly involved in that expire next Friday, well, there was tons of trading late in the day, bigger pockets of trading. Those calls were worth $6 or thereabouts at one point, $13. Lots of volatility. We still don't know whether he actually owns them and whether he plans to turn them into stock or if he's part of that trading yesterday, Matt.
All right, interesting, as always, to follow the GameStop story. And also, Tesla is a huge one, Abigail, that we're going to continue to talk about. Those shares jumped this morning, as she just showed you, ahead of the shareholder meeting.
The biggest AI project on Earth is autonomous driving. And of course, Tesla is in the pole position for that.
We'll speak with an analyst who's bullish on the stock of a company that may pay its CEO a package worth $56 billion. Pierre Ferragu of New Street Research joins us next. This is Bloomberg. Tesla's annual shareholder meeting kicks off this afternoon. Shares are surging after the CEO, Elon Musk, said shareholders voted, quote, by wide margins, end quote, in favor of reapproving his compensation package, which could be worth as much as $56 billion, and moving the company's legal home to Texas. Joining us now is Pierre Ferragu, New Street Research Global Team Head of Technology Infrastructure. He has a buy rating on Tesla and a price target of $245. Pierre, great to get your take on this. First of all, the plan. I don't know the details. You do. That's why we have you on. But if a company's going to pay its CEO a package that could be worth $56 billion, I don't know that I'd want to be invested in that company. It seems like a lot of money.
Yeah, it's a very strange way to think about whether you want to invest in a company or not. Like the 56 billion taking out of any other company sounds very odd. Think about it a different way. If I promise you for like multiplying by 10 your money, then I'll get paid 10% of the value of the company. And if I don't reach that goal, I'm not going to get paid. Do you feel that my compensation package is well aligned with your interest? And that's the way you should think about this compensation package that was signed in 2018, in which Elon was promised to get vested, the ability to buy shares in the company at the valuation of the time over the years for a total amount that would amount to 10% of the total value of the company over a long period of time. And so that was a very, very well aligned package in terms of aligning the interest of the CEO with the interest of shareholders without any possible doubt.
I totally get that, Pierre, but here's the thing. And, just on principle, fair is fair, right? If you voted back then to give him the prize, if he achieved the targets, now he's achieved them, so he should get the prize. I get that. But now, looking back, it just seems like way too much money to pay someone, and you have a chance not to do that. Plus, you could get rid of a CEO who's busy doing way too many other things, a lot of people would say, and not necessarily great for the brand. It seems like a double whammy. Why wouldn't you vote for that?
Yeah, you're creating a situation that is a bit odd, because you're telling me about a company in which you're invested, but you're telling me you don't like the CEO and you don't like the influence of the CEO on the company. So what are you doing here?
Well, things change, right? I mean, there was a time when he was focused solely on Tesla. Now he's got his focus also on Twitter. He's also focused on SpaceX. He's also focused on Neuralink. He's also focused on the Boring Company. Plus, he's also focused on all of the social and cultural arguments that he seems to get in all day, like how can you spend that much time on Twitter and still get stuff done? This guy has a lot of other stuff to do.
Yes, and he has been doing a lot of other stuff for the last 10 years, so I still don't understand why you would be in this company. You're creating a situation that doesn't exist. Someone who doesn't like Elon Musk, someone who thinks he's too busy. He has been as busy as he is today for the last 15 years, even the last 20 years, so nothing is changing. So you're creating a situation that doesn't make sense. People who are invested in Tesla today, they believe in the mission of Tesla. They believe in the value of having Elon Musk on board, and they voted very rationally in favor of that. And that explains very clearly a very simple fact you see today, which is that shareholders have voted in favor of the package. And that's the reality. So, of course, yes, people who don't like Elon Musk probably would have not voted for that package. People who think he's too busy, people who think he's damaging the brand, all these people would have not voted for the package. But as a matter of fact, they don't have any voting right because they are not shareholders of Tesla.
What about his damage to the brand? I mean, there was a time when he wasn't so outspoken on sensitive issues, and he clearly did the world a favor in bringing electric cars to the market. He achieved something that at the time no one thought was possible. But now I hear more and more consumers say, you know what, I don't want to be associated with Elon Musk, so I'm not going to buy that car. And it does look like they actually have a demand problem in terms of selling their vehicles.
Well, I'd be curious to see where you've heard these consumers telling you that, and if you can put me in touch with them, I'd be interested to see that. So, publicity is publicity, and when you're talking about bad publicity, you can also look at the bottle being half full and not half empty. Elon Musk has like hundreds of millions of followers, is making headlines absolutely every day. And Tesla, as a matter of fact, almost doesn't spend any money on marketing. So just that is gigantic value. Bad publicity is still publicity and is still very, very valuable. And then take a step back. You seem to be very evaluating the situation in a very emotional and subjective way, which is that you think everybody thinks that way, or that like the net effect of the personality of Elon Musk is a negative. But he seems to be a pretty popular guy. And what about all these people who buy a Tesla and are Elon Musk fans? You seem to miss them in your equation. So for one person who is getting upset by like a very polarizing personality, maybe you have another person that is actually very enthusiastic about it. So yes, there is a demand issue for Tesla. You pointed it out. That's right. That's really like the number one controversy on the stock today. I wouldn't associate that to this idea that Elon Musk would be damaging the brand. I think it's a shortcut that doesn't really make sense from like an analytical standpoint.
Right.
The situation that we have today is that Tesla cars were selling so well that at some point, Tesla management, the market, a lot of observers, including me, thought that market could keep growing and more and more people could buy these cars.
Okay.
What we've realized in the last 12 months is that these people are actually not that many, and we need cheaper Teslas for Tesla to keep growing.
Okay. Hey, Pierre, listen, I'm just trying to take a contrarian view with the bullish analyst. I appreciate your time. Pierre Ferragu of New Street Research. Coming up, we're going to give you the morning calls, and then later we'll speak to Adam Hetts of Janus Henderson, who's seeing opportunity in U.S. small caps and mid caps. This is Bloomberg. Time now for our morning calls. First up, Goldman Sachs initiating coverage of the restaurant sector with a selectively constructive view. The firm is establishing 6 buy ratings, including Starbucks. Wolfe Research raising 3M to outperform, saying the new CEO, Bill Brown, has the right stuff to provide confidence in the medium term. And finally, Bank America upgrading Kimberly-Clark to a buy, citing long-term improvement taking hold. Coming up, we'll speak to Adam Hetts of Janus Henderson. This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we do see futures higher across the board. Tesla is one of those companies that could drive today's trade, as Elon Musk says shareholders are going to approve his pay package. You can see here the closing bell being rung, and hear it as well. Let's take a look at the start of trading at a couple of the other assets that we follow. The euro right now at 108. Just about even. The U.S. 10-year yield at 426, 427 after dropping yesterday. It continues to fall another 5 basis points today, and NYMEX crude up about 15 cents to $78.66. As I said, Tesla, one of the stocks that we're tracking at the open, those shares jumping after Elon Musk said shareholders voted by a wide margin in favor of reapproving his pay package. Bloomberg's Global Autos editor Craig Trudell joins us now. So, Craig, what do we know about the shareholder vote. They did already vote to approve his pay package once, as the last analyst I had on told me. Now they have a do-over, and they still think he deserves that much money.
Yeah, hoping that twice is the charm essentially here. But this is far from a done deal. We know that this was really more of sort of symbolic significance or a case of avoiding what would have been a catastrophe, in the sense that, had Tesla gone from, getting approval for this back in 2018 and tried to go back to shareholders to get them to give the okay over again, had they not gotten the thumbs up, it really would have hurt their case with, trying to fight this in the courts. And that's really where this is headed next. This is not a case of, after today's shareholder meeting, Musk, leaves with a bag full of stock options. It's very much still going to be dependent on the legal system.
Craig, it's still to me fascinating that Vanguard reportedly votes in favor of this. I mean, Jack Bogle would be rolling over in his grave. He's all about saving money, or was.
Yeah, it's interesting, and that was, of course, a report from DealBook that we've not confirmed just yet. But the amount of support for this on the part of some big institutional investors, I think of Bailey Gifford, Ron Barron. Some of these names are not necessarily huge surprises, but we did also see some opposition to this, both among big institutional investors and even some retail shareholders who in the past have been big Musk fans. And it is interesting, and sort of unprecedented, not just the scale of the compensation here, but also the fact that it's now sort of, up in the air as to whether or not it will ever be paid out. And shareholders being asked to approve it, sort of retroactively after he achieved, the targets that were laid out for him way back in 2018.
Right, and we should remind people also after they approved it already. Craig, thanks very much. Craig Trudell, our global auto czar, talking about Tesla. Let's turn to chips now. Broadcom has its biggest surge in 4 years after results show huge demand for AI products. Abigail Doolittle has more on Broadcom. Abby?
This is really impressive because it is having its best day, as you mentioned, in more than 4 years, since March of 2020. So that's the degree of buying power that we're seeing. Investors liking a few things. They beat both top and bottom line estimates for the quarter that was. In terms of sales for the full year, the company is now saying that it will be closer to $51 billion. That's versus the street at $50.6 billion. And that's versus their previous projection of $50 billion. So that's basically $1 billion better. And a lot of it, as you're mentioning, having to do with AI. Now, they don't sell the AI chips that NVIDIA does, but lots of components in there. In addition, they did buy that VMware, and they've really integrated it more recently. Lastly, Matt, they're following in NVIDIA's footsteps, doing a 10-for-1 stock split. Investors really liking that a lot. The street very positive. The stock right now up 13%. And you could say that Broadcom today is leading NVIDIA, not the reverse in some of those other AI chips.
Yeah, well, a share split like that definitely makes it more palatable to retail investors who might be thinking $1,700 is too much for me to pay for one share. Abby, thanks very much for that. Let's get a look now at Dave & Buster's, which missed estimates. Alex Semenova has more. Not enough video game customers?
I guess not, Matt. It was a really rough quarter for Dave & Buster's. CEO Chris Morris said in the earnings statement that complex economic conditions continued to weigh on consumer demand. Earnings per share came in well below Wall Street estimates. Revenue fell 1.5% from a year ago, and same-store sales declined 5.6% from the same period last year. That was worse than the decline Wall Street analysts had expected. The company didn't quantify guidance, but they did say that sales and profit did improve during the quarter. The current quarter, as they improved some of their stores and built out their loyalty program, though they did say that these macro headwinds continue to be a problem. Restaurants, of course, have been grappling with the dilemma of having to raise costs to cover higher food and wage costs, while also not turning away inflation-wary consumers. Truist analysts expect Dave & Buster's sales initiatives to offset some of these macro headwinds by the fourth quarter. Jefferies said that Wall Street estimates for the quarter were overly optimistic. The stock is down about 10% right now, the worst since September 2022. Matt.
Have you ever been to a Dave & Buster's, Alex?
I think I may have been like once in my life, certainly not anytime recently.
Well, I'm going to go and check it out again. Definitely haven't been there in 10 years. Alex Semenova on Dave & Buster's, thanks very much. Here's a Virgin Galactic are falling after the board of directors agreed to a 1-for-20 reverse stock split. That's because they're worth almost nothing now. Katie Greifeld is here with more on this penny stock. Katie?
Yeah, we are talking about a literal penny stock here, really trying to hold on to its listing on the New York Stock Exchange. Of course, it's trading for about 79 cents a share right now. And when it comes to staying listed on the NYSE, typically stocks have to maintain a minimum average closing price of at least $1 a share for 30 days. So the stock fell below $1 a share for the first time in April. At that point, basically the company proposed this reverse stock split, and now the board has approved it. That is 1-for-20, the reverse stock split there. So we'll see, of course, how that transpires. You can see shares down about 8% right now, but this company is obviously dealing with some very fundamental issues. Just to catch you up here, it performed its last space flight of the year a couple days ago. Now it's taking a hiatus from commercial operations. It plans to pause sending tourists to space in order to focus on developing a new class of space planes known as Delta. You take a look at the reaction in shares, down over 65% year to date. This company obviously has its work cut out for it.
All right, very interesting stuff. I just saw a red headline earlier that Lufthansa is going to invest more money than the entire value of Virgin Galactic in an Italian airline. It's worth in total less than $325 million. So, but we'll continue to keep an eye on Virgin Galactic. Katie Greifeld, thanks very much for that. In the next hour, Katie and I are going to be speaking with the CEOs of Snap-on, the American tool maker, and DHL Supply Chain. That's coming up at 10:30 a.m. New York time, a roundtable interview that you don't want to miss. Now, Adam Hetts, global head of multi-asset at Janus Henderson, weighing in on yesterday's big day, writing, underneath noisy market reactions to nearly every data release, a consistent signal of a resilient and likely improving economy can be heard. He joins us now. Adam, thanks so much for your time. We got yet another sign that inflation is slowing with PPI today. It actually dropped month over month, and we were expecting a gain. Is this really all good news for the economy?
It's a good question, Matt. Thanks for having me on. And maybe the next one of these we can do from Dave & Buster's. Yeah. But I think that's a good start. So the noisy data out there, the supposed good news for the markets, I do think it might be a dangerous game that the markets and investors are doing here is cheering all the bad news for the economy to root for that translation to good market news and good policy news. So it's been really exciting. It's made for this exciting rally, and that's been good. But I do think it's also a neurotic rally. And it does leave me a little bit concerned from here to the rest of the year, thinking about it could be setting us up for potentially a double-digit drawdown at some point between now and the end of the year. But it doesn't mean we can't be up between now and the end of the year. I think that's just as likely. But those double-digit drawdowns are likely any year. On average, we do have a 16% drawdown in the S&P, even in years that don't include recessions. So I think the biggest risk when investors are trying to process all the data out there, the good and the bad and maybe the ugly from time to time, is that if we do have a bit of a reset, given demanding multiples, given demanding earnings projections, that's not necessarily an indictment on the underlying economy. As we wrote, we do see some good, profound, lingering drivers of some economic strength and reacceleration. So we do think investors need to tap into the data there and stay tuned into that, even if there is some near-term volatility in the top-line market levels.
I see that, and I keep going back to the World Bank assessment of the U.S. economy and the global economy, raising their estimates for both this year. On the other hand, we got today initial jobless claims a tick higher than we were looking for at 242,000. That's also higher than the previous week. Continuing claims also ticked higher than they were last year and higher than we were looking for. And then, of course, we got the household survey last month saying that unemployment ticked up to 4% even, and a loss of 400,000 jobs there. Does the labor market worry you at all? Cracks in the labor market?
Maybe we live in interesting times, right? So PPI release, objectively, maybe bad news. You know, it's talking about a slowing economy, jobless claims up, slowing economy. But then you had NFP last week, non-farm payrolls were up. Market sort of shrugged that off. That was good news that needed to be shrugged off to continue the market being good. And so when you put all this together, what I think it really means is that there are potentially some cracks coming, but we have such a strong foundation, it can survive a few cracks. I think underneath it all, more profound drivers we're talking about, like you mentioned, global GDP, US GDP, global manufacturing data, real income data, all very strong and staying strong. So I think if you really focus on that, then take a broader portfolio view, even in the face of potentially near-term volatility, like I mentioned, a potential drawdown in the S&P, you can look at that as more of an opportunity to invest more and hopefully broaden out of what are a lot of concentrated portfolios right now.
You know, you run multi-asset at Janus Henderson. Lou Wang at Bloomberg News wrote a great story about the bear market in diversification a couple of days ago. And I keep thinking about this because, you know, we've been trained that diversity is the safe way to invest. On the other hand, you'd be much better off just buying an S&P 500 index tracking fund for the last 10 years. How do you look at this? I mean, right now, all your eggs in one basket seems to be the winning solution.
Yeah, I've thought about this once or twice over the last decade or so, Matt. And sure, for the most part, if you've been diversifying, you've been defending, and it keeps working in that now everybody has these golden handcuffs, in my view, as far as the concentration, Magnificent Seven, even just the top 5, this historic level of concentration in the S&P. So I think that the delicate piece right now is you're thinking about this economic reacceleration, and we're pointing to some of the objective data that are driving that view, but it's still late cycle. We can stay late cycle for a long time, but it does make it an environment for risk-taking, albeit careful risk-taking. So when we're thinking about getting out of just that concentrated S&P exposure, it means going down in cap in the US, it means going ex-US. So it's not just the other 493 or even 495 in the US, it's also getting ex-US. But that's delicate. You have to be careful because when you're getting out of the S&P, you're getting out of these large cap growth exposures, which can be more defensive in nature, and you're taking more cyclical risk in a late cycle. So there are some hedges to that in the sense of we're going down in cap, we're going international, but we're staying active, we're leaning towards growth, we're leaning towards quality, and we're seeking out those margins of safety in case there are some speed bumps ahead, even if we stay late cycle for a long time.
By the way, yesterday I was listening to Bloomberg Business Week on Bloomberg Radio, and I heard a bond investor talk about looking at and getting into uranium. When you look at the different asset classes, I mean, stocks and bonds we talk about all the time, but copper's been an incredible story. Uranium's had an unbelievable run. What do you think about, and you know, on the inverse side, you know, grains have had a tough time. What do you think about commodity investing right now?
From a multi-asset perspective, that ties right into the late cycle thesis here, which is probably what brought you to that. That should be good for commodities. We're talking about still a somewhat inflationary environment, this economic strength, this reacceleration, this demand that does drive, you know, good demand for commodities, and should be a relatively good market for commodities as a broad asset class. I think if you look at the 3 legs of the stool from an asset allocation perspective, you think about commodities from a capital market assumptions perspective, at least when you look at our long-term capital market assumptions, you're talking about relatively modest returns, relatively high volatility, but typically very low correlation. So going back to the diversification point, that is a valuable source of diversification because it does have that low correlation, and it does tie into the late cycle stage that we're in, which should be helpful for broader commodity prices.
Just to round out with another asset, FX I think has been interesting in that we haven't seen a lot of movement of late for the dollar, but you know, in a strong economy, the Fed shouldn't have to cut rates, especially with stocks at an all-time high. Meanwhile, the ECB just cut, the Bank of Canada just cut. Is there a little bit of a central bank divergence that you think is going to start making waves in FX?
There are a few things to unpack there. So first, as you put it, it's this tug of war with fixed income yields because you've got this strong economy that should be pushing yields up on the 10-year, but then you have the supposed Fed cuts at the end of the year. Although we were rounding to 10 Fed cuts at the beginning of the year, and now we're rounding almost to 0. But still, you have that downward pressure on yields. So you have this tug of war with traditional fixed income yields in the U.S. The U.S. 10-year right now, of course, treading water around the 4s, kind of mid to low to high 4s. And so if you take that as the premise for U.S. yields, and to your point, you're having this monetary policy divergence from ex-U.S. where you're already seeing cuts and more willingness to cut. So then that is short-term good for the dollar. I think from an asset allocation perspective, zooming out a little bit, that's not necessarily something that I think asset allocators want to trade on right now because it's a very volatile part of the portfolio. When we talk about the fixed income part of a multi-asset portfolio, I think I just leave it as we do stay dollar hedged unequivocally just to limit that currency volatility in the fixed income portion of the portfolio. And then within the equity portfolio, we're broadly unhedged in the equity portion of the portfolio. So maybe to tie that all together with an asset allocation perspective, I don't think that the currency risk is a huge driver right now. But also to your point too, I think that the dollar strength right now, that still should be stable for the foreseeable future.
Adam, great having you on the show. Thanks so much for joining us. We'll meet up at Dave & Buster's after. Adam Hetts there, Global Head of Multi-Asset at Janus Henderson. Coming up, Apple rides the AI wave.
Apple has kind of regained its seat on the throne here, next to the top players. And I think the story there is, pick up in China, and then also some talks of the AI integration and things like this. They're finally on the map with that. We just hadn't heard anything compelling from them in a long time about that.
We'll take a look at the company's record-breaking week next. This is Bloomberg.
You saw nothing today that's better than the competition. You saw nothing today that's different from the competition, except marketing and a focus on privacy, right? So that's the difference here. They're not the first, but they're also not the best, and they're not the most advanced. They're here extremely late, and they showed up to the party without a gift.
Apple has been on a wild ride in terms of the stock. Briefly, market cap overtaking Microsoft yesterday. The recent strength coming after the company revealed its long-awaited new AI features earlier this week that didn't really seem to be much at all. Bloomberg's Abigail Doolittle joins us now for more. Abby?
Yeah, this one is a bit puzzling, and it's up again today. Right now, its market cap, at least the last moment I looked, more than Microsoft. It's pretty extraordinary that you think not so long ago this stock was basically in a bear market from its December peak. Yesterday's move higher, I don't think I've ever seen anything like that on a major stock coming out of a range. Up 14% over the last 2 days into today at the highs. That was the most since 2008. It really felt silly given the fact that the AI evaluation not so strong. Although to be fair, I've had some people on X reaching out to me saying that their AI is better than some people are giving it credit to. But what I'm really looking at, valuation at this point, well higher than the group, 30% above, 42% above from a PE standpoint at the high end of their range. Plus, Matt, the numbers, single-digit growth. For this year, their top line is expected to grow 1%. That's after dropping 3% last year. Next year, if they get it together, 6.5%. The bottom line is also single digits. So when you put it all together, does that mean that a stock should basically over the course of less than 2 months, or basically 2 months at this point, be up? Let's see. I think that it's up, more than 20%. I mean, it's just a massive, massive run in such a short period of time, but especially this week.
Yeah, and I mean, the interesting thing for me about Apple has always been how much cash they have. At times, $200 billion. Right now, it looks like, more than $100 billion in cash. And yet the dividend is like a quarter a share, right? They do buybacks at some points, but I feel like, yes, we're locked into the ecosystem, those of us who use the iPhone, and this is going to hold us a little tighter to it, but they really need to give back some cash to shareholders to justify not coming out with any new products, canceling the car. I mean, just not really innovating.
Well, right now, I'm not sure that I necessarily agree because the stock is doing pretty well. Investors seem to be fine going in on this massive valuation, even without that justification. Some people, actually, Alon Rosen over at Oppenheimer, he was telling me yesterday that there is talk out there that the upgrade cycle that will be revealed in September is going to be huge. But something I would point out, this stock on this move hitting up to the top of a very reliable range. The technicals here are not very supportive. There is the possibility it could break out of the range as it did do about 2 years ago and then come back in. But the RSI or momentum over the last 5 years, Matt, it is weakening. It's really telling you that as the stock hits these all-time highs, it's on less bullish confidence than it had been a few years ago. Something else I would point out, Berkshire had been selling. The way that it has popped out of this range, it feels like it's either a big player or it's just a simple trading vehicle. In terms of when Apple was going down, you had NVIDIA, Microsoft, all these other tech companies going up. Some are saying that it was being used as a funding short for that. And now those investors, almost like a seesaw, they want to be in their big tech that goes higher. It's Apple, but what goes up must come down. That's sort of how it feels like with Apple here, especially given these fundamentals. And also, yeah, what you're talking about in terms of not really increasing that dividend, at least yet.
All right, Abigail, great to get a look at the technicals with you, as well as more on this story. Apple adding just an immense amount of market cap in its run-up this week. Abigail Doolittle there on the stock. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary. What you need to be watching. Treasury Secretary Janet Yellen will be speaking at the Economic Club of New York at noon Eastern. And then later this afternoon, Tesla will hold its annual shareholder meeting. The big vote on the potentially very big pay package, surely the biggest in history. We'll also get Adobe earnings after the closing bell, so you can continue to watch what tech does in terms of earning money. Overnight, we're going to get a Bank of Japan decision. If you want to follow along on your Bloomberg terminal, type BOJ GO. And tomorrow we have the University of Michigan consumer sentiment data. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.